Hi, welcome. It's been quite a week, right? And we're heading into another week that might be just as rollicking. And as we all look for answers, I was looking inward. And this whole process for me started on Wednesday when I was on a flight to, I was boarding a flight to Latin America, going to Chile and Argentina, and I was checking my phone for the Yankee scores, which is what I usually do, when a news story crossed my phone, and you're all aware of that story, of the Trump tariffs being announced after the close of trading on Wednesday. And over the next couple of days, it's clear that markets have been completely put off balance by this, and collectively, US equities have lost about 10%. As we'll see, it's been a global sell off. I've been wrestling over those 2 days, and since I was working for much of those 2 days, I didn't have much of a chance to look at markets, but over the weekend as to how to get my bearings back. The word that I look for during a crisis is serenity, some place where you can make peace with yourself, because until you do that, you're going to be reactive and doing what everybody else does. I won't claim that I've resolved all my doubts. This is a work in progress, and this might be the first of many sessions that I do on this topic. But I thought I'd take a deeper look at the data first and what's happened over the 2 days, and then step back and look more generally at what happens during the course of a crisis. So let's start by what it is on Wednesday that caught the market by surprise. It wasn't the announcement of tariffs per se, because not only has Donald Trump been talking about that all through the election, he's been talking about it through his entire life. It was the magnitude and the breadth of the tariffs. Let's start with the breadth. It was across the world. In fact, this map shows you the countries that were hit by the tariffs, and the countries that were not are not exempt. If you look at North America and Canada and Mexico in particular, the reason they're not colored in is that there's another set of tariffs that Trump has for those countries that's not covered by this particular announcement. You're saying, what about Russia and North Korea? I mean, these are countries that are covered by sanctions. In theory, there is no trade. If there's no trade, there's no point for sanctions. So pretty much everybody was hit by the tariffs. That was the first surprise. The second was the magnitude of the tariffs. I mean, people were expecting a tariff, but not 30, 40, 50% tariffs. And finally, the basis for the tariffs themselves was a little mysterious. At first sight, it looked like it was tariffs to counter tariffs by those countries, but it's really in response to a balance of trade with those countries. Countries with which the US had a significant trade deficit were hit more by the tariffs. So that effectively also means that rolling back the tariffs is not going to be easy to do, even for countries that say we'll drop our tariffs, because you can't make trade balances go back to zero overnight or ever for some of these countries. Now, as I said, the market was surprised and it reacted in predictable ways. It went down, and in this table, I look at the effect of the tariffs after close of trading on Wednesday, which is the second, and you can see almost all of the effect unfold on the third and the fourth, Thursday and Friday. And you can see it in the Dow, the S&P 500, and the Nasdaq. The Nasdaq was down more than the S&P 500, but not by a huge amount. The S&P 500 was down 9%, the Nasdaq was down 10%, the Dow was down less, but I'm not even sure, to be quite honest, what the Dow captures other than the legacy effect of the 30 companies in the Dow. So the market was clearly down based on the indices. Now, one of the things I've discovered is the indices sometimes hide the nuances in the data. So I went in and downloaded the market caps of every publicly traded company in the world, just because I wanted to slice and dice the data to see what Thursday and Friday delivered. Let's start by looking across regions. So in this table, I have broken down by sub-region the market caps on 31st December 2024. So the market cap coming into 2025. The market cap as of the previous Friday, March 28th of 2025. And the market cap at the close of Friday trading on April 4th of 2025. So if you take Africa, its market cap declined by $369 billion over that week, over the last week, about 7.04%. So as you look across the regions, this is a surprise, at least for me. The worst hit region is what I call small Asia. And the small there is really a misnomer. It's Asia without India, China, and Japan, down 12.6% and $838 billion. Now, some of that might be because of some of those Southeast Asian countries being dependent on exports. Vietnam, Indonesia is a commodity company, but some of it might be other factors coming into play. The US with 9.24% was the second worst hit. The UK is pretty close. The least hit markets were China and India. And again, it's a little early to be spinning stories, but those are two countries with very big internal markets where even if trade globally starts to feel frictions, you have a domestic market that's large enough to carry you. So at least for the moment, there isn't a single region of the world, at least based on the last week, which had a good week. But some regions had much worse weeks than others. Now for the rest of the data slicing, I'm going to focus just on the US because in many ways, the market effect hasn't fully played out in the rest of the world. Let's start by looking at across sectors in the US as the worst hit and the least hit. The worst hit sector was technology. It was down coming into last week, down 13%. It dropped another 11.6% last week. And if you look at materials, second was 10.10%. Energy was down 14.2%. In fact, energy was worse off than technology, even though the drop in value was less, $338 billion. Technology lost $1.8 trillion just over the last week in market cap. We'll come back and take a deeper dive into the Mag 7 and the biggest tech companies. But clearly the pain is spread out across the board. The least hit sector was consumer staples. And again, it's a little early to be spinning stories, but you can argue if the economy is going to recession, that will be the sector to be in. Utilities down 4.4%, not that much of a surprise because you often tend to see utilities move less than the market in either direction. But all firms collectively down 9.24% and $5.3 trillion just last week. Was the carnage worse among small rather than large stocks? Not really. It looks like small companies, large companies were pretty much all hit. There doesn't seem to be much of a discernible difference between small and large cap stocks, at least based on the last week. In fact, coming into last week, the smallest stocks in the market had done worse than the largest stocks, but last week they pretty much were even in terms of how much they lost. I also looked at the US stocks broken down by PE ratio from highest to lowest. I actually looked at earnings to price because it's a more robust multiple. You don't lose as many firms. And you look across the board again, there is some difference. The stocks with the highest PE did lose more than the stocks with the lowest PE. The highest PE stocks were down 11%, so this should be the lowest PE, and the lowest PE stocks were down only 8% during the week. So it's mild support, at least for the notion that there was some movement of capital, or less dropping off in the lowest PE stocks, value stocks as opposed to growth stocks, if you want to use that shorthand. I also, building on that safety question, I looked at whether companies with more debt were worse affected than companies with less debt, and at least so far, the reverse seems to be true. Perhaps this has to do with the technology companies feeling the brunt of the pain or the biggest chunk of the pain. The companies with the least debt, which are technology companies often have very little debt, were down 9%. Companies with more debt actually were down 8%. That's pretty unusual because in a crisis, usually companies with more debt feel the pain. Now, staying on the safety theme, there is at least this belief that dividend-paying stocks are safer than non-dividend paying stocks. Well, at least so far, that doesn't seem to be playing out. Dividend-paying stocks were down 9% last week. Non-dividend paying stocks were down 10%. Stocks that bought back last year in 2024 did drop a little bit more, but not by enough to actually argue that there is a statistically significant difference. So in terms of cash return, last week was not discriminating. Companies returning cash, companies not returning cash, all saw the pain. Finally, there was a story floating around, at least towards the end of last week, that this was just an unwinding of the momentum trade. What does that mean? That the stocks that went up the most last year were being the ones sold off? at least at first sight, I don't think that looks like there's backing for it because if you classify stocks based on what they did in 2024, the worst performers for 2024, it is true, came into last week having done better than the best performers. But last week by itself, both the worst and the best performers both got hammered. They're both down about 9%. Now, of course, the very best performers over the last couple of years have been the Mag 7 stocks. I focused just on the Mag 7. Let me hit you with the numbers first because the numbers are always staggering with the Mag 7. Just last week, the Mag 7 stocks lost $1.55 trillion in market cap. That's about 10.35%. But they came into the week already having shed 2.6 trillion in market cap, 14.8%. Collectively this year, the Mag 7 have lost $4.2 trillion in overall market cap. Now, I did look at the Mag 7 with and without Tesla because Tesla has been the worst performer for over the course of the year. But last week, Tesla looked very much like the rest of the Mag 7. But coming into the week, of course, Tesla was down 35%. So with or without Tesla, the Mag 7 have had a tough year and a tough week. But looking at just the last week, the Mag 7 and the rest of the market looked pretty much on par. It wasn't the Mag 7 sell-off that caused the overall market to drop. Now, of course, whenever you have a crisis, other markets show it. So the first market I went to was the U.S. Treasury market, and I looked at the yields across the spectrum, 3-month, 2-year, 5-year, 10-year, 20-year, 30-year, starting the year and going all the way through last week. Coming into last week, at the start of last week, the rates were already down. The 3-month rate was down 0.04%. The 10-year rate was down 0.3%. Last week, they pretty much continued on the trend with short-term rates again down, but by very little. The 3-month rate actually didn't change by very much. Unusually again in a crisis, because usually you see money going to cash, is around 0.05%. Rates across the other maturities were down, but not by the amounts you'd expect during a crisis. It's about 0.2 to 0.3%. Now, a little later in this session, I will look at what happened to Treasury rates during the COVID crisis, during 2008. But so far, at least, the effect has been relatively mild. Treasury rates have come down, but not at the levels you'd expect if you had purely panic selling where money was going into cash. I also focused on 3 very diverse investments: oil, gold, and Bitcoin. Oil as a stand-in for commodities. And commodities last week were down 14%. No surprise here, partly because if the tariffs are going to slow the global economy down, commodity prices will come down. Now, I looked at gold, the collectible of long standing, and usually collectibles, the definition of a good collectible is it holds its value and the market is melting down, and hold a gold, which has had a very good year so far, up 17%, held its value last week. I also looked at Bitcoin, which is millennial gold, at least it's put as a replacement for gold. And it surprised me because in every crisis since its creation, Bitcoin has behaved like a very risky stock, dropping more than stocks. When they go down, going up more than stocks. For the first time, and it's very early in the game to draw judgments yet, for the first time, at least for last week, Bitcoin held its value. It was actually up 1.57%. Perhaps there's hope for Bitcoin as a collectible. So I know it's very, very early in the game, but I'm going to try to see, at least pause at what I see in the tea leaves. Based on the 2 days and what the market has done, it seems more to me like a marking down of equities than panic selling. What does that mean? That people think equities collectively are worth less now than they were on Wednesday because of the expectations of big tariffs and a tariff war. And I'm sure there was some panic selling on Friday, but the flight to safety has not been as pronounced as you'd expect to be. It were a lot of panic selling. What do I base it on? Treasury rates are down only about 10-year rates down only 0.25, 0.26%. There seems to be little difference between the performance of safe stocks, low PE, high dividend yield. In fact, mixed evidence. The low PE stocks did a little better than dividend-paying stocks did a little worse. But the differences are small. They're not of the magnitude you expect if there was a lot of panic selling. And it doesn't look to me like it's a momentum trade reversal. That has already happened coming into the week. I think this was just a week where people sold off equities and marked them down. So let's take a step back. Clearly we are in a crisis. The question is how big, how long, and where will it end? So I drew up a picture of what usually happens in a crisis. There's usually a trigger event. There are warnings often leading into the trigger event, but there is an event. That event sets off a market reaction. That market reaction takes two forms. It takes the form of the only thing investors control, which is stock prices, which they mark down, and they take the cash and put it in treasuries, so treasury rates fall. So stock prices fall, treasury rates fall. That's the initial reaction. And investors do what the only thing they can do, which is mark down prices because they're worried about the future. Now, in the aftermath, there are these aftershocks that come from the event. Now, those aftershocks can be small or large, sometimes positive, sometimes negative. In some, they cause more market volatility, and they usually cause the market fall to extend more negative aftershocks and positive aftershocks. So it takes a little while for the trigger event to fully play through markets. Now, while this is all happening, there are some real effects that trigger event usually creates. Those real effects will be on the economy in the near term, where usually the economy slows, perhaps to a recession, and inflation is affected by the real economy slowing. So clearly, those short-term effects, for the economy, consumer confidence will fall, unemployment will go up, all the standard bearings of a recession. That's in the near term. In the long term, the trigger event could actually change the economy, and it could be positive or negative, but the net effect will play out in the long term on the economy, on interest rates, inflation, which then feeds back to risk-free rates, to treasury rates and equity risk premiums. Now, after all of the crisis is done, of course, the postmortems begin. Academics write papers, regulators drop new rules and laws, politicians talk about how this crisis should never happen again. And for the most part, the worry here is you're reacting to a sample size of one. You're over, I think, reading the tea leaves, not considering all the pathways that were not taken. You look at the actual pathway the crisis took, and you're convinced that that is the only pathway that was feasible. In my view, you often draw the wrong conclusions about crises, and you get a false sense of security of how these crises always play out. Mysterious, but I'm going to take two crises and take them through this process. Now, I was teaching in 2008, in fact, in the middle of a semester, and of course, when September 12th, that weekend came along, and Lehman Brothers, there was talk that Barclays was going to take Lehman into its arms because Lehman was in trouble, but Monday we woke up to the collapse of Lehman Brothers. That, of course, triggered a market reaction that started on September 15th and stretched through the next few weeks. And between September 12th of 2008 and December 31st, stock prices fell 28% and treasury rates went from 3.72% to 2.21%. Market reaction. Now, the initial week, the drop was about 11-12%. And then it was in the following weeks that you saw the rest of the drop. Now, the rest of the drop, of course, was triggered by aftershocks. What were those aftershocks? I remember weeks in 2008 when there was talk that Morgan Stanley might not make it. Goldman was in trouble. I mean, those did not come into play, but the aftershocks took the form of other banks being in trouble and having to bail them out, and signs that liquidity was drying up around the world. Okay? Now, in the real economy, the Lehman collapse led, of course, to a recession, a fairly long and deep recession. But in the near term, the economy slowed, unemployment soared, consumer confidence dropped. The real effects were there, and the S&P 500, was reflecting that with its earnings dropping by 40% in 2008 versus 2009. Now, in the long term, did the 2008 crisis leave its scars? Absolutely. It left its scars in economic growth. I mean, we didn't get back to a degree of economic health till almost 2012. Unemployment went up to 10% in 2009, stayed stubbornly high. Consumer confidence took a while to come back. But most critically, and I've said this before, 2008 destroyed our trust in institutions. Now, the postmortems, of course, concluded that 2008 was caused by banks behaving badly, that they lent money on housing, or invested in mortgage-backed securities without following through with their due diligence, and that if you put restrictions on banks taking risks, that you would never have another 2008 again. I'm not sure that's true, but that is the conclusion we draw, that this was all created by banks behaving badly, and we had threw ratings agencies into the mix saying they screwed up as well. So that was the 2008 banking crisis, and one of the things I started doing in 2008 is, to me, the essence of a crisis is when the trigger event hits, investors get scared, and when they get scared, they sell stocks, prices go down, and the equity risk premium, the price of risk, goes up. So investors, when they get scared, push up the price of risk. So in 2008, I started estimating the implied equity risk premium. For those of you who don't know what this is, take a look at some of my sessions on the equity risk premium, because I'm obsessed with this idea that this is the one number that tracks the balance between fear and greed in the market. So if you look at the green line, that's the implied equity risk premium by day from September 12th of 2008 through December 31st. So September 12th, the crisis hits, the price of risk goes up a little bit, but not by much. But in the weeks following, you can see the price of risk drift up as the index comes down. Peaked on November 21st of 2008 at about 8%. It ended the year at 6.43%. The immediate effect of a crisis is on the price of risk, because nothing else has had a chance to adjust yet. It's a price of risk going up. So let's move on to the 2020 COVID crisis. The trigger again was a news story out of Italy that said that dozens of COVID cases had been discovered in Italy, and none of them could be traced back to China or cruise ships. And there went a delusion that somehow this pandemic could be restricted to cruise ships in China. In the days following, markets sold off. Initially, the sell-off was about a 12% drop in the 2 weeks right after the news story, but it continued. It continued through March 23rd, and by March 23rd of 2020, stocks had lost 31% of their value. Treasury rates, which had started the crisis low, 1.62%, dropped even lower to 0.76%, a historic low. And the aftershocks took the form of both health stories about pandemic out of control, as well as economic stories of businesses shuttering down, people losing their jobs. The short-term effects were pretty dramatic. Unemployment rose above 20% in the quarter after the economy looked like it had come to a complete standstill. And it looked very much like a really long and deep recession was looming. S&P 500 earnings, not surprisingly, dropped in that second quarter of 2020. But here's where there was a shift in that particular crisis. We very quickly came back, at least in terms of economics. Maybe that was because of government spending, billions and billions, hundreds of billions of dollars in checks, sending them out to people. Maybe because of central bank actions. Whatever it was, we came back quickly. The economy bounced back. S&P 500 earnings, by the time all was said and done in 2020, looked very much like 2019. And the market returned quickly back. So clearly there was that initial impact, but it didn't last. The postmortems, of course, concluded that governments and central banks could keep us out of trouble even in the worst possible crisis. Now, I did track equity risk premiums again during the 2020 crisis. They started about 4.4%, peaked on March 23rd at about 7.8%, very much like the 2008 crisis. But here was the difference. In 2008, it took years for the equity risk premium to revert back to where it was before 2008. In fact, it didn't happen by 2012. In the case of the 2020 COVID crisis, equity risk premiums by September were back to where they were before the crisis. It was a very quick pass-through crisis in terms of the price of risk. Now, with each of these, of course, I talked about the postmortems, and I do think we sometimes draw the wrong lessons as investors. We look at those crises, and what do we conclude? That markets always come back, even from the worst possible crises. The problem, though, is the fact that a catastrophic event did not unfold does not mean that the probability of it occurring was zero at the time the crisis unfolded. Let's go back to 2008. It is true that the worst case scenario did not unfold, that Goldman and Morgan Stanley and other banks did not go under, but there was a very real chance that they could have. In which case, what the market was initially reacting was in fact perhaps an understatement. So the fact that it did not happen doesn't mean it could not have happened. Similarly with COVID, was there a possibility that the economy could have gone into a deep standstill? Absolutely. The fact that it did not happen is we're thankful it didn't happen, but it doesn't mean that the chances of it happening were non-zero. And I would say the same thing here. As you look at a trade war, I mean, you could conclude that this too shall pass, and that might be the most likely scenario, but it doesn't mean that markets are not right in assessing a probability that this could end very badly. So for investors, the lesson that you should always buy at the heart of a crisis, if you're a contrarian with a long time horizon, you'll always make money. That might be a bad conclusion, because sometimes catastrophes are truly catastrophes. They happen and the market will stay down. And that's why we demand an equity risk premium. Second, for regulators, they pour through these crises to see whom they're focused on whom to hold responsible rather than what. In other words, they focus on the symptoms rather than the causes. And many of the fixes they make are to the symptoms. Was the problem with 2008 just banks taking on bad risks, or was it just general risk taking? In 2020, was the problem with COVID and how it played out, the way the economy was structured? Again, we dealt with the symptoms, not with the problems. And academics and researchers and intellectuals, of course, take these crises and they beat them and take them apart after the fact. They can take on the air of rational people looking at these irrational investors reacting in real time. So when you have books that come out of the crisis, it's often about how short-sighted investors were and how businesses did not do the right thing, when in fact, in real time, they were doing the best they can. I cut market slack during crises. They're doing the best they can in real time. And I wouldn't say the same thing about many experts passing judgment on these markets. So let's see where we are in the tariff crisis. Trigger event, of course, was the Wednesday event. Of course, though there were warnings that this was coming well before. That trigger event set off the selling on Thursday and Friday, and as you saw, the market, the U.S. equities are down 9% globally. Equities have lost $9 trillion, but that's where we are. As we lead into the opening of trading on Monday, which it's just coming up, Monday, April, I guess 5th, 6th, 7th, April 7th, we will see more aftershocks. So we already saw the first aftershock on Friday with China reacting with its own tariffs. We will get more stories like that of the EU and other countries reacting, and and some will react with tariffs of their own, which will risk triggering another round of tariffs, and some will react by taking tariffs off. So there'll be good news and bad news. So it won't be an unmixed story. There will, of course, be rumors that will float around that the tariffs are going to be paused, they're going to be changed. That might cause the markets to react. But those aftershocks will play out as higher market volatility is a given. And if history is any guide, the pain you felt in the first week will continue, even in the best case scenarios, for a few more weeks. As for the economy in the near term, I mean, the likelihood of a recession has already been raised from 25 to 50%. I mean, and it looks like the economy will slow down even if it doesn't go into recession. The price of oil and commodities suggests that the market believes the economy is going to slow down. And the big question is, how will that play out in the earnings for U.S. stocks? But they will go down, but by how much? I'm going to be tracking analyst forecasts of these earnings. Analysts take a while to reflect those real changes. In terms of the long term, a tariff war, trade war can only slow the global economy down. That I think is going to be the likely outcome. And the US, as the largest economy in the world, will also slow down. I think the one piece of good news here might be that inflation might come down as the global economy slows down. So even though you might have that one-time hit from tariffs, those tariffs will not cause long-term inflation, might slow the economy down to slow inflation down. And for those who've been concerned about risk bubbles in markets, this might very well deflate those bubbles. So the real effects long-term, a slower economy, perhaps lower inflation in the long term, but that effect is still unpredictable. And that's going to play out in treasury rates and equity risk premiums in the foreseeable future. And finally, there will be postmortems, and I'm sure that there will be fingers pointed and culprits named. But as I said in my post on globalization, this is part of a backlash against globalization that stretches back to 2008. And it's not just one person or one set of actions that have triggered it. So it's in process, and we're going to see it play out. And of course, as I said, it's very early in the game, and I've started tracking the equity risk premiums by day, and I will continue to do it till I feel comfortable not doing it. So if you look at the equity risk premium at the start of this month, it was, in fact, I did the equity risk premium prematurely on March 28th, but on March 31st, that equity risk premium was 4.59%. It drifted down on April 1st, which was Tuesday, to 4.57%, drifted down further to 4.54%. And then, of course, you got Thursday and Friday, and you can see it spiked back up almost to 5.808%, almost more than little bit more than 0.5%, which is a big move for an equity risk premium. As Treasury rates have come down somewhat, at the start of trading on Monday, we're looking at an expected return of 9.09%. Note of caution: these equity risk premiums are computed with the analyst earnings numbers, and they're, as I said, slow to react. So I will have, as I go through in the coming days, I will be updating those earnings numbers as they come out. And we'll see where the equity risk premium goes, because if history is any guide, this will be the number that tells you where we are in this crisis, and when the crisis is effectively crested and it starts to kind of go into retreat. So there's a lot of the story that's left to be told. As we're going to have to be watching the aftershocks in terms of tariffs and counter tariffs and trade wars, and those stories will be both negatives and positives. Those aftershocks will create more volatility, so I wouldn't be surprised to see more big up days, big down days. But there will be more down than up, and there is more downside if history is any guide, at least in the next few weeks. For the real economy, I think you're going to see signs of it slowing down. Whether it'll actually go into recession is still up in the air, but it will slow down, and I do think you're going to see a dampening of inflation, even though there might be a spike in those things where you're particularly dependent on outsiders, and the rest of the world for your inputs or supplies. In the long term, as I said, global growth will slow down. The US will slow down with it, and we'll have to see how it plays out in inflation and real growth in the long term. Now, of course, one of the downsides of a crisis is you have experts coming out of every possible crevice. And I classify them broadly into three groups. The first and the most obnoxious of the groups is the "I told you so" groups, which have been waiting forever for a market crash, and now they have it. They'll say, "I told you so." I mean, what they don't tell you is if you'd listened to them right from the beginning, you'd have been in cash for the last 11 years, and with or without the crisis, you're actually better off not listening to them. But they're going to be out, and they're going to take whatever agenda they have and use it to push through. That's the reason this crash is happening. You're what I call knee-jerk contrarians, and these are the exact opposite. They tell you to buy because they said if stocks go down, they always come back. And as I talked about earlier, it's a dangerous investment strategy of just buying just because the market is down. Because when markets mostly come back, they don't always do. The third is, of course, the hand-wringing group, which is I can't decide, there's too much uncertainty, they present one side, the other side, and finally they conclude it's too confusing, too uncertain, that you should just sit on your hands and wait till the uncertainty passes. There are elements of truth to all three of these groups, but I don't think there's particularly useful investment advice in any of them. So you're saying, what's your advice? I'm not a great fan of giving people advice because I think we all need to take ownership of what we do, whether as investors, and we can't turn that over to others. But I think the choices you make will depend on three things. First is your needs for cash in the near term, for healthcare, for taking care of an elderly parent, for buying a house, paying tuition for your kids or for yourself. So the cash needs and time horizon are kind of bundled together. So if you need cash right now, then don't sit around. Cash out, take the cash out. You don't have the luxury of saying, let's wait for a better time. So if you have cash needs, my advice is take the cash out now. If you don't, then you have the luxury of waiting. You don't have to, but you have the luxury of waiting. It'll depend on your macro views, and don't stand behind or don't hide behind the argument that you're not a macroeconomist, because really there are three possible choices here of how this will play out. The first is an open trade war. We have tariffs and counter tariffs and counter tariffs, and that's a worst case scenario. You have a partial trade war with wars with some countries, but a lot of other countries folding and essentially pulling back from the trade war brink. And there's a complete clearing of the air for whatever reason. Either the tariffs are paused or somehow get renegotiated down. You're saying this is an economic question. Not really. It's a game theory question as to how this will play out. An expert poker player might be better positioned than a macroeconomist to make that judgment. Third, it'll depend on investment philosophy. I teach a class, and I've long argued that you cannot be an investor without investment philosophy. What goes in investment philosophy? A set of beliefs about how markets make mistakes and then correct them. And also a philosophy that best reflects your personal wake-up. Are you patient? Are you long-term? So those are the things that go into your philosophy. So you have to make your own choices. But I'm not going to cop out. I'll tell you what I plan to do during this crisis. And please don't view this as some kind of model for yourself, because you have to make your choices. I am first going to compute, as I mentioned earlier, the equity risk premium by day. It might not work for you, but for me, it keeps me grounded. It tells me here's where we are in the market, and it gives me a sense of calm. It is, like Winnie the Pooh needs his honey for his happy place. I need my daily ERP to keep going. I have companies in my portfolio, and I will revalue them because the effects of tariffs are going to play out in disparate ways. Some of them might be helped, some of them might be hurt. I have to decide whether they should be staying in my portfolio. Many of those, all those companies on March 28th, I viewed them as undervalued, or either not overvalued enough not to sell them on March 28th. The last week could have changed that, so I've got to revalue them. I did own the Mag 7 coming into the year. I sold Tesla shortly as the year began because I felt that no political decisions. It was really based upon the fact that I could not see the revenues and earnings being high enough to justify the $400 per share. Quite sell it at the high, but I sold it pretty close to the high. NVIDIA, I hold a quarter of what I owned before 2023. So that is a much smaller holding. The other Mag 5, and I need to revisit those because those companies might be exposed in particular as global companies to a trade war. But I also will keep my eyes open for great companies that might become bargains. I've often drawn a distinction between a great company and a great investment. A great company makes good investment decisions, has great management, amazing moats. A great investment, it's all about the price. I have a list of great companies that I've looked at and said, I wish I could buy the company, but not at the prevailing price. That list will come into play because if there is panic selling, as there will probably be some time during this crisis, and everything is sold, and there's no discrimination as to good and bad companies, some of those great companies will become bargains, and I plan to buy them. But I also know that if I have to make that decision in the midst of a sell-off, it's going to be tough to do. So, and this is purely me. I put limit buys on companies I really, really like during crises like this and let the buy happen automatically, because that stops my psychology from stopping me from doing things. And just to give you two examples of companies that I've wanted to buy on March 28th but looked expensive but might become bargains during this crisis. One is BYD, the Chinese electric car company that I talked about during my last session as my replacement for Tesla. But I also mentioned at that time with an ADR that my value is around $75. The stock was trading at 100, and I said it's too rich for me to buy it at 100. Stock now is down to 86, 88, and who knows? 2 bad days from being a buy. So I put a limit buy on BYD at a price less than my value. The other company is a company I valued last week in Latin America, Mercado Libre, quite a fascinating company, a company that is like Amazon in many ways on the retail front, but like no other company that I know in terms of the fintech front that's managed to create in Mercado Pago, a fintech company that not only does payment processing for the retail, but also is becoming effectively a bank and a fund manager. And again, a company I really liked, but I valued around $1,600. It was trading around 2,200, and after by Friday it was down to 1,800. So who knows? Again, 2 bad days away from being a buy. So those are both limit buys. No, they happen. They happen. But most important, I'm not going to spend the next few days obsessing about markets, watching every move every day. What is it going to do anyway? It's not going to change what markets are going to do. So I plan to go back to living, from taking advantage of life's small pleasures, walking my dog, Yankee win, to big ones. My granddaughter's birthday is in a few days, and I can't think of anything that happens in the market that would even compete with that in terms of life's big pleasures. So my advice to you is don't let this become the center of your life. And most of all, remember the sleep test, which is if you're lying awake at night wondering what your portfolio is doing, you failed your sleep test. So far, at least, I'm sleeping well. I'm not wondering what my portfolio is doing, and I hope I can keep doing that through the next few weeks because I know that I will be tested. I hope you found this session useful, and I thank you very much for listening.